Hello, everyone, and welcome to 10-Point Primer for board members and property managers. This is one of several Mackoul School classes that we teach. I like to say you're never too old to go back to school, and you're never too young or old to learn something new. So hopefully we are going to teach you some new information today. I am the president of Mackoul Risk Solutions. Our agency specializes in insuring co-op and condominium associations, as well as the owners and property managers. Along with me today are Samantha Tucci and Vanessa Cusimano, who will be hosting the class. The webinar will be recorded, and you will be receiving a copy of the recording afterwards. Also, use the Q&A button at the bottom of your screen to ask questions. We will attempt to answer them as we go, rather than waiting to the end. So don't be afraid or hesitate to ask any questions. So we're going to get right into it. And let's start. 10-Point Primer for board members and property managers. Point number one, it's not natural to live in a co-op or a condominium. What do we mean by that? Well, if you own a single family home, it is very easy to understand what is your responsibility. Pretty much everything. That includes the floors, the walls, the pipes. You are responsible if someone gets injured. You are responsible for your contents. If you can't live in your home and you have to live elsewhere, you're responsible for that. Very easy to dictate that and understand that in a single family home. Now let's take a co-op or condominium. Is a multifamily building, and it is dictated by the bylaws, basically, responsibility within the unit. And what happens is people get confused because there's generally two areas in the bylaws which relate to responsibility within the unit. One is maintenance, and the other is damage to a destruction of. So maintenance is very simple. You have exclusive access to that unit. So in almost every case, you're going to be responsible for maintaining certain things. Whereas if it is damaged by a covered peril, let's say a fire, your responsibility may be different. So I'm going to give you a couple of examples here. One, that pipe under the bathroom sink. That is your responsibility to maintain it as an owner, simply because you have exclusive and access to it. So if that pipe is leaking and needs to be replaced, well, that's considered maintenance, and you as the owner are going to need to replace it. Now let's take an example where there is a fire in the unit, and the fire damages that same pipe. Well, that pipe is going to be the association's responsibility to repair. So people get confused because they think, well, my responsibility is to maintain that pipe, and if that pipe causes damage, well, that's my responsibility. And that really isn't true. What I say in 95% of the cases, it's not what caused the damage, it's what was damaged. Okay, so keep that in mind. So that pipe may have been leaking. The pipe leaking isn't the trigger in most cases as to who is responsible. If that pipe leaks and causes damage, so let's say it's my pipe, I live in apartment 3A, and that pipe bursts or leaks and causes damage to Vanessa's unit below me after she just put a new kitchen in, and then can damage Samantha's personal property because she lives on the first floor. Well, just because the pipe was my responsibility doesn't make it my responsibility to repair Vanessa's new kitchen. That would be her responsibility because that's what's dictated under the bylaws. Just like Samantha's contents would not be my responsibility either. So the bylaws dictate what the responsibility is. It's typically not the insurance policy. The insurance policy generally goes by the bylaws. Now let's take that a step further. I said, and most of the time it is not what caused the damage, it's what was damaged. Well, there's got to be exceptions. What are the exceptions? The first one is negligence, okay? Negligence is defined as what a prudent person wouldn't do. So if someone in Unit 3J left the bathtub running, which I have seen instances like this, we had one time a husband was going to run a bath for his wife and got distracted watching the football game and ended up overflowing the tub, and water went everywhere and caused damage. Now that is negligence. That is clear-cut case of negligence. And in that instance, that couple was responsible for the damage they caused not only to their own floor, but to the common areas and apartments below them. Okay, so negligence is one of the exceptions. Now let's go over what negligence is. Negligence is not a pipe leaking. Negligence is not a water heater bursting, even though it may have been outside its 10-year life expectancy. The insurance company doesn't consider that to be negligence, nor do they consider a hose on a washing machine or on the ice machine bursting. Those are not considered negligence. Now, what is negligence? I'll give you several examples that have happened in buildings and that we insure. We've had children stuff dolls down the toilet and flush it to see a whirlpool. Toilet overflows, negligence. We've had people fall asleep in their bed with a lit cigarette. That's negligence. We've had instances, like I said, where people have left the bathtub running, overflows, negligence. One of the most common ones we see is the association shuts down the water in one of the lines to do repairs, and someone walks into the unit, turns the water on and says, oh, that's right, the water's off. And they walk back out of the bathroom or the kitchen without turning the faucet back off. And when the water's put back on, that overflows. Okay, that's considered negligence. So again, it's what a prudent person wouldn't do. Now, just keep in mind that sometimes negligence is not an easy thing to prove. What is another exception? Deductible resolutions. We're seeing more and more of these be put into play. And what they are basically is the associations in some case are amending the governing documents by adding these resolutions to put more of an onus on the owners. So let's say the association has a $10,000 deductible. They are putting the onus on any owner who is damaged by a covered cause of loss. So let's just say we have a water damage claim. That person causes damage to both Vanessa and Samantha's unit. Well, since they were both involved, they would both pick up a portion or $5,000 of that $10,000 deductible each. So these deductible resolutions are changing the onus, and that would be another exception to it's not what caused the damage or what was damaged. Just to continue with point one, the bylaws I indicated before dictate the responsibility of the owner and the association. There's typically three ways an association should be insured. You will not normally see this terminology in the bylaw. I mean, you'll see the terminology, but you will not see the terms bare walls all in a single entity. So let's start with bare walls. Bare walls only applies to condominiums, and it's maybe 5% of the time we see that. What that basically says is the association is only responsible for the structure itself and putting up the four walls, the ceiling, and the original floor. And the owner has everything else, including partition walls, all the cabinets, everything they can see, feel, and touch other than the floor, the walls, and the ceiling. So there's much more of an onus on the owner and less of an onus on the association to insure. Then there's all-in coverage. That's kind of the opposite of bare walls, and that too is also only in condominiums, and that too is also only in a minority of the cases, so maybe 5% of the time. And that basically says the association is responsible for everything in that unit, including any improvements or amendments made by an owner. Okay, so realistically, an owner in a condominium that has all-in in the bylaws doesn't even need to have coverage for their unit. Yes, they still need to have coverage for contents and other areas, but they don't have any responsibility for insuring anything inside the unit itself. Then you have single entity coverage, which is probably 90% of condominiums and pretty much 100% of co-ops. And what that is, so it goes under the name of single entity, original specifications, or build to spec. And basically what that says is the association is responsible for replacing the unit back to its original condition at the time of conveyance. Okay, so basically purchased by the original owner, and that the owner is responsible for any improvements or betterments. And keeping in mind, when I say improvements or betterments, it may not just be mine. So if Vanessa bought the apartment, made some improvements, and then sells the apartment to me, I am now responsible for those improvements. The association is not. Okay. And again, really all co-ops and most condominiums are assured this way. There is some difference in the wording. Typically in a co-op, though, the owner is still responsible for finishings, carpet, painting, things like that. That is the way most associations are written. Point number two, homeowners insurance and risks shareholders, unit owners face if they are not properly insured. Homeowners insurance will provide for several different areas, and these are the 5 main areas that we say every owner should have coverage for. First off is improvements and betterments. That's the coverage to rebuild and restore what you're responsible for in the units. We've already talked about how they could be different based on the governing documents, but in most cases, you have some responsibility, even if it's a relatively new unit, and that may just be paint on the walls. So you need to have improvements or betterments coverage. Then you need to have contents coverage. The association is typically not going to be responsible for damage to your contents. So it may be a pipe in the wall that is causing, that is leaking, and that pipe may be the association's responsibility. But if it causes damage to your contents, remember what I said earlier, it's not what caused the damage, it's what was damaged. So the contents in almost every instance, if that is damaged, is going to be the owner's responsibility. So if you want that reimbursed for damage to that, you need to insure it. Then you have additional living expenses. This is kind of the same as contents, really. The association does not have a responsibility to put you up and pay bills to you if you can't live in your unit. So additional living expenses for an owner will cover them for the additional living expenses they incur when their apartment is uninhabitable due to a covered cause of loss. So we see this with fires, a fire or heavy water damage where the unit is unlivable. You have owners who have to live elsewhere. They may have to live elsewhere for 6 months, a year. We've seen longer. They don't have access to the kitchen. They have to eat out in restaurants. So this coverage will pay for them to live and sleep in a hotel, to eat out of the restaurant. In some instances, people go out and get temporary apartments. It'll pay for their apartments. Because again, it's not the association's responsibility to put you up or take care of the expenses. It's your own. Then you have personal liability, and this covers a couple of different areas. It being your unit, whether you're a shareholder or in a condominium, a unit owner, if someone slips and falls inside the unit, they're going to sue you. One, the liability covers you for that. Secondly, we talked about it before, we talked about negligence, and that's the main part. So most associations want their owners to maintain personal liability because when they are negligent and they cause damage to either another party or to the association itself, this is where it's picked up under, okay? So personal liability is going to cover the owner for their negligence. And we've also talked about how they're responsible inside the unit, but liability insurance is also worldwide. So it doesn't just cover the owner inside their unit, it covers them outside as well. So we've seen instances in our agency where a child was swinging a baseball bat and he hit somebody. Well, the parents of the child that was hit by the baseball bat, they sued. And this is where coverage is picked up. You will see dog bites. So if your dog bites someone, you can be sued. And typically the insurance policies will cover it as long as it's not an excluded animal. And then lastly, you have loss assessment. Loss assessment basically is coverage. If the association is not maintaining adequate coverage, they can assess the owners. So we saw a lot of this after Sandy. So we see it most of the time these days in properties where they have a high wind deductible, or they don't have enough coverage in a certain area. So to give an example, if you have water backup, let's say there's $250,000 of water backup inside the co-op's policy, but we have a $500,000 claim. Well, there's only $250,000 worth of coverage, so the co-op could assess all the owners that $250,000. As long as the peril is covered under the owner's policy, the assessment will be covered by the insurance company. It also allows the loss assessment also will cover deductibles in most instances. So you have a lot of situations now where associations are going with higher deductibles and they are assessing the owners to make up for their deductible, and loss assessment would pick up that assessment.
Point 3, do business with knowledgeable professionals who specialize in co-ops and condos. We're talking about insurance brokers, attorneys, accountants. We use the comparison in that you wouldn't go to a podiatrist if you needed brain surgery. Any broker that you work with typically specializes in specific types of insurance. They may still be able to write all types of insurance, but you should go to someone who specializes in condos or co-ops if that is what you're looking to insure. For example, you wouldn't go to like an Allstate to insure the building. You could go to them to insure your unit or your auto, but that's not something that they typically specialize in. We also, as brokers, will attend board meetings. So you should always have your broker attend a board meeting every year. We're there to provide guidance and advice, not only to the board, but to the owners as well. It's part of what we are paid to do. So, utilize us for as much information as as you need. I've attended plenty of board meetings, and sometimes it's easier for us to answer questions, to the owners on the building's behalf. This is what we do every day. So, more often than not, a lot of people have questions about the insurance, whether it's, regarding the premiums or claims, you know, uh, anything to do with the insurance. A lot of times there are a lot of questions at these board meetings. So we just recommend to have your broker, come in at least once a year to speak on the building's behalf.
And it is much easier these days with Zoom and other video platforms. So there's no reason why you can't get someone on at least once a year to answer questions.
Point 4, know your insurance company. Deal with insurance companies that specialize in condominiums and cooperatives. There are plenty of carriers out there that may provide a quote. It doesn't mean they have the same coverages or policy form that a carrier who is tailor-made for condos and co-ops would have, and what we'd suggest an association should have. You can refer back to your broker on that too. Ask them if the carrier quoting or who they're marketing out to specializes in condos and co-ops. All carriers have an AM Best rating. That pretty much tells you the financial stability of the company. They go from A+ and down. A lot of times people are looking for the best, A+, they think. A lot of mortgagees require A+ or A, but what you don't see from the letter is anything else really about the company, which is just as important. So you want to talk to your broker about how they handle their claims. Maybe they're financially sound because they're not paying out claims as much as another carrier is, and they're denying more. That's just as important as their financial stability. So definitely speak to your broker about what they've come across working with these carriers.
Thank you, Samantha. And that is absolutely what you need to keep in mind is AM Best just really rates their financial stability and their financial size. They do not, anything you see in terms of a letter or a number grade doesn't really have anything to do with how well they pay their claims. Point number 5, directors and officers liability. There was a stat in the New York Times years back. It's been several years now, but it basically holds true that 70% of all D&O lawsuits are lodged in 5 states: New York, New Jersey, Florida, Texas, and California. So we happen to be one of the most litigious states. I think we knew that already. There was a stat in a different publication that basically said that 65% of all co-op and condo board members knew of a situation that could lead to a suit against the board. So it's pretty scary to think that 2 out of every 3 associations knows that something could be brewing that could lead to a suit against them. And directors and officers liability can be written in different ways. So you may have coverage, but it may not be as good a coverage as you need. So if you don't have proper coverage, a suit naming a board member basically personally places them in financial jeopardy, puts their personal assets at stake if the association doesn't have proper coverage. Now, most bylaws, they say most, not all, because it isn't all, but most bylaws do indemnify the board members for what they're doing. But I have seen plenty of governing documents that don't have it in there. And so if you're not being indemnified by the association and you are named in a lawsuit and the insurance coverage isn't covering it, you are going to reach into your pocket to defend it. So we always preach having a standalone policy, which we're going to get into in a second here, rather than an endorsement. Let's go over the most common D&O lawsuits first off that we see. We see wrongful termination of an employee. We see discrimination claims, defamation of character. Breach of contract is the new kid on the block for the last 5, 6, 7 years. And what that is you have, I'll give you some of the situations that we have seen. Was a boiler problem in the middle of the night. Company had to come in and do emergency work. The association felt they were being overcharged, refused to pay the vendor. The vendor sued them. That is what's called breach of contract. The D&O policies these days, the good ones, will provide a defense for breach of contract. They won't pay if it is deemed that you owe that invoice and that money, because that they consider that a business decision, but they will defend the breach of contract, and we see that more and more. We see a lot of suits regarding renovations, subleasing, noise, and pets. So those are the most common D&O lawsuits. All lawsuits must be defended, regardless of whether they are frivolous or not. They must be defended. I can tell you the most D&O suits are not, they're not typically for monetary damage. Okay, the people are just unhappy with the decision the board has made, and so they're suing. And so the standalone policies that you see with a Travelers or a CNA or a Chubb, they're built to be for a co-op or a condo. You are paying more money for them, absolutely, but they cover some of these. They cover a lot of the different suits that we just discussed. They cover non-monetary damage lawsuits. You can have an endorsement to your liability policy that provides directors and officers liability, and it may be $250. It's a lot less than the standalone, but they exclude most of the common things like discrimination. They will exclude non-monetary damage lawsuits. So no matter how frivolous the suits are, they have to be defended. And if you don't have proper coverage, you are still going to have to defend it, and the board is going to be reaching into their own pocket. So we say quality of coverage is paramount. A standalone policy is a must. It provides much broader coverage. And I take that a step further and I say I'd rather see $1 million of a standalone policy than $10 million of an endorsement, because the endorsement isn't going to pay for some of these really high 7-figure lawsuits or high 6-figure lawsuits we see. Management firm needs to be insured under the contract because they are going to get named in every lawsuit along with the board. And their management contract typically contains an indemnification clause that says that you need to defend us if we are named in a suit along with you. So you want to make sure the D&O policy provides coverage to the management firm. Now, the good thing is most of the larger carriers that we talked about who specialize in co-ops and condos automatically include the management firm these days. If you rewound 10 years ago, you had to name them, they had to endorse the policy. They've done away with that. So if you're with the companies who specialize, you don't need to worry about it. But in this day and age, and sometimes you may not be eligible for those companies, there are other companies who write D&O insurance, and you just want to make sure your management firm is listed as an additional insured, because you would hate to have the board being defended, but now you need to reach into your pocket to defend the management firm. Just want to check questions real quick. It would be great to address the bigger decisions and the transparency needed recommended in the decision process to include shareholders, sale of rights, etc. You know what? I think that's more of an attorney question. So I think we're going to defer answering that one because I don't see the insurance question there. We're going to go on to the second one. How does broker or corporation know the insurance company's payout policy? Experience would be the answer to that. There are only a limited amount of companies who specialize in insuring co-ops and condos. As Samantha had said earlier, every company can really write a policy, but it doesn't mean they specialize in it. So there are a limited amount of companies. We tend to deal with all of them, and same with most of the brokers who specialize in co-ops and condos. They will get a feel over the course of time, because if they see claims that are being denied that they feel should be paid, you get a general idea of how good the insurance company is paying their claims. Article 78 come into play when the board normally be insured for the first question. Jennifer, I'm going to ask you to just be a little bit more, type out a little bit more while we go on to the next point. I'm going to ask you to just kind of clarify that a little bit. All right, let's go to point number 6.
Point number 6 is recommendations and requirements. The insurance companies will typically go out and inspect within 30 days of writing the business. They're doing this to basically prevent claims. They typically look at your sidewalks. When doing that, they may require you to fix cracks or uneven areas, or they may want you to make parking lot repairs. A large one is upgrading your electric from fuses to circuit breakers. They even if you have circuit breakers, they may find that you have Federal Pacific stab locks, and these breakers have a high rate of failure. So although, these updates can be an annoyance and costly to the association, the insurance company is looking to reduce the risk, which also benefits the building. You don't want multiple claims on your loss history. This typically will increase your premiums, or even have the carrier non-renew your policy for like a high claim frequency. And then it's more difficult for you to find a replacement carrier once your policy is non-renewed. So they go out and do this to make sure that you're maintaining your property. They may want you to install emergency lights, exit signs, hardwire battery operated smoke detectors. We're seeing that carriers are becoming more and more aggressive in getting compliance in a timely manner. They are following up more often. They are non-renewing policies if it's not done within, the time frame of the renewal. So even though they might not non-renew you, within a couple of months because you didn't complete their requirements, they may not offer you a renewal on the next year. So and then when you go out to shop your policy, the carriers may say, why was your policy non-renewed? And when you tell them that, we didn't comply with some of their loss recommendations, that carrier will also ask, what were these loss recommendations? Were they taken care of? So it's kind of, a cyclical thing where, one carrier may get off, but the next carrier is still going to be looking for a response on this. They all basically are looking for the same types of things, electrical, roof repairs, elevators being maintained, sidewalks being maintained. So this year I think we've seen them do more follow-ups, non-renewals than ever. They also have been looking at HPD or DOB violations. You can go on the DOB website yourself and search your building's violations. If the carriers see that they have multiple open violations or any critical violations, they may automatically decline to write the insurance for your building. We're seeing the umbrella carriers do this, but I think in the future, we're going to see the property and liability carriers follow suit. And a lot of the carriers are, not making any exceptions. So if there are open violations, they won't even look at the risk. They automatically decline. So if your building does have open violations or fines, anything like that, we recommend that you have those taken care of right away, because they are cracking down on those as well.
Right. I understand we are in one of the, if not the worst hard market in real estate history. And so carriers really have a tight guidelines of what they want to insure. And so one, by doing some of these, and don't be fooled by it saying recommendations, because the insurance companies call them loss control recommendations. They are requirements in almost every instance. They want to see this. And the more of this that has been addressed and the more that you have in terms of life safety, the more attractive you are to other insurance companies. And like you said, the umbrella carriers, there aren't too many programs right now writing higher limits, but I see a lot of insureds who would decline simply because they have HPD violations or DOB violations. And although they're getting quotes for the package, they can't get an umbrella or a decent umbrella because of that. So address them, and it will behoove in the future when the market turns a little bit. There'll be many more carriers looking to insure you.
Point 7 is transfer risk to commercial occupancies. So if the association and building has any commercial tenants and spaces, we urge you to have them maintain general liability insurance and name the co-op or condo and property manager as an additional insured. Just like we suggest that you or your bylaws have all your unit owners maintain their own insurance, it's really important that your commercial tenants do as well. you need to obtain a certificate of insurance naming the co-op and condo and property manager as an additional insured. That means you need to maintain it. You need to see when it expires and ask for the renewal each time, so there's no lapse in coverage. We want to put the responsibility on the commercial tenant if something were to happen, and off of the association and the property manager. A lot of times they're, heavy foot traffic in these commercial spaces, and it could cause a claim, a liability, a lawsuit. And we want to make sure that the commercial tenant's always properly insured. Same goes if they hire anybody to do work inside their commercial space, just like you should have the proper risk transfer documentation for the a contractor the building hires. You want to make sure anyone hired by the commercial tenant has the right information as well. Again, you want the tenant to name, the contractor's tenant, name the co-op and condo and property manager as additional insured, and require them to sign a hold harmless agreement. That puts the responsibility back on the contractor and off of the tenant, the building, and the property manager.
Right. Anytime you can transfer the risk, we want to do so. And that's the importance here with the commercial occupancies. Let's go to point number 8, no insurance, no entry, a guide to hiring contractors. This is one of the classes, another Mackoul school class we teach, so we could probably talk about this for hours. Just going to try and cut it down to some of the main facts here. Remember, no insurance equals no entry. Okay. New York labor law places almost total liability on the building owners. And what that means is this: if an employee of a contractor or a contractor gets injured on the property, in almost every instance, it's the building owner's responsibility. And it doesn't make a difference whether there was negligence on the part of the injured employee or not. So New York is really the only state that is that way. You get outside of New York, different states have contributory negligence, which basically says, well, if the injured party was 75% negligent, well, then only the property owner is only responsible for 25% of the judgment. In New York, again, in almost every instance, including anything height related, it's known as the scaffold law. The association, the property owner is basically held responsible, and it's very difficult to get out of it. And a lot of the time they turn into 6-figure lawsuits. We've seen 7-figure lawsuits. I've even seen 8-figure lawsuits where contractors have been injured on the job. First off, the cooperative or condominium should obtain a certificate of insurance naming the building and the property manager as additional insureds. Let's just put a disclaimer there that says, yes, you do want to get a certificate, but a certificate by itself is not enough. A certificate really is just a snapshot. It's a piece of paper that basically says this is the coverage they have that the contractor or that insured has on that day. And it really doesn't go into a little bit more. So we're going to go into it a little bit further down. But keep in mind, you do also want to get a certificate. The certificate should reflect all the policies they have, general liability, including products completed operations, which is defective product or faulty workmanship. Should also show workers' compensation and umbrella coverage in some instances. And yes, we get the question all the time, well, I'm a sole proprietor. Why do I need workers' compensation? And the reason being is if you get hurt on the job, you will be able to seek benefits under the association's workers' comp. Plus, the association, when their workers' compensation policy gets audited, they're going to pick up any payments to contractors, and if those contractors don't maintain workers' compensation, it's going to be picked up as payroll. So now they have the association paying a much higher workers' compensation cost. Besides the certificate of insurance, what is critical is there must be a written contract in place signed by the contractor requiring them to name the building owner and the property manager as additional insured. All shareholders also should have these requirements. And the reason being is most contractors have what's called blanket additional insured in their policy. And blanket additional insured basically says, hey, we'll name anyone that you are required to name as additional insured. But then it goes on to say, as long as there is dictated in a written contract. So you may have supplied a certificate of insurance saying that the property owner and the property manager are additional insureds. But if the contractor's policy requires something in writing and there's nothing in writing, you are not an additional insured. And we've seen plenty of instances where a certificate is supplied and it indicates additional insured coverage. And that isn't true because there was no written contract in place. So you want to have a written contract, you want to get the certificate. The written contract should also include a hold harmless agreement in the property owner's favor. Basically, it just says that the contract is agreeing to hold the association and property manager harmless for any injuries they cause. And then lastly, you want to get a full copy of the contractor's policy. It should be reviewed by the association's insurance broker or the property owner's insurance broker to confirm there aren't any detrimental exclusions in there. And we've seen many, we've seen situations where contract, we get a copy of their policy and they have restrictions on working on buildings that are 4 stories or less, but they're working on an 8-story building. We've had another instance where we picked up that a contractor, his insurance policy is only covering New Jersey. Well, he was working in New York. So we can't pick that up off of a certificate of insurance. And that's the reason why I say you need more than just a certificate of insurance. So our agency, we have a separate department that does a complimentary review for our associations that are hiring contractors. And that's what we require. We require a copy of the policy, a copy of the contract and a certificate, and we do a review and let you know whether it's that they have adequate insurance at the association or the property owner is going to be properly protected. And your insurance broker should do that as well. And all shareholders should also be following this requirement as well. So if they are hiring a contractor, there should be something in writing requiring that contractor, and it could be an alterations agreement, name the owner, the property owner or association and property manager as additional insured as well, because same theory applies here. If the contractor has blanket additional insured in the policy and they don't sign off on a contract or something acknowledging that they're required to name these parties as additional insured, you're not an additional insured. So those in New York, very critical. That's actually one of the reasons why we're in such a hard market right now, is over the last 7 or 8 years, the insurance companies have seen more of these labor lawsuits, which are, again, injury to contractors or their employees, that have exceeded the $1 million limit. So they're piercing the umbrellas. So you got the underlying carriers who are saying, hey, we've got to raise premiums. Then you got the umbrellas who are basically bailing out of New York and saying, we don't want to write umbrellas here simply because they're piercing the umbrellas now. Point 9, who should be an additional insured? This is really related to the management agreement that is signed between a board and the property manager. And we're seeing more and more cases where the board is requiring the property manager to name them as additional insured in their policies. Now, let's take a step back here and understand that as the property manager, they're going to get named in every single lawsuit that the association gets named in. So the property manager's contract, is typical for them to have an indemnification clause, and they're saying, you need to defend us and you need to indemnify us. And that's what protects them, because otherwise they manage 100 properties. They'd have 300 claims against them every year, because every year there's a claim against the association. Well, there'll be a claim against the property manager. So it's standard to be in the property manager's favor. But we're seeing more and more attorneys put it in there that they want the property manager to name the association as additional insured. So let's go into the various insurance policies that the property manager may have. Well, we have general liability, but most of the time, the general liability policy has an endorsement in there basically limiting coverage to the designated premises. So basically their office, and that's what it's being limited to. So unless you were to have someone get injured at the property manager's office and name the association in a lawsuit, which it doesn't make any sense, there's no coverage there. So what the attorneys are looking to do, they're saying, hey, well, if there's a suit at the property and the property manager is negligent, we want them picking up the lawsuit. But again, their policies limit coverage to their office space, basically, and their policies don't want to provide coverage. So let's take that management firm that has 100 different properties they're managing. If the insurance company for their liability didn't limit coverage to their office, they'd be providing coverage for every instance at every location. And we used to insure a property manager, and there was a company who was providing coverage at each of the different locations. They had no exclusion. They had no limitation on the designated premises. And so there was an instance where a garage came down and injured someone, and the property manager, because their policy, and I don't want to get too technical here, but every insurance policy has an other insurance clause. And the property manager's policy said they're primary, and the association's policy said they were excess. And so the property manager's insurance had to defend and pay out the injured party. Property manager was not happy. Neither was the insurance carrier. So that is why they started restricting coverage to the designated premises, and why it doesn't make any sense to have them listed as additional insured, because you're not really getting any the ability to do so. Most of the companies simply will not do it. Now let's take another policy that the property manager has. They have what's called E&O insurance or professional liability. So if they're not meeting the terms of their contract, you can sue them. So the board can sue the property manager, and that's where their recourse is. So if you're unhappy that the property manager didn't do their job correctly, you can sue them under the policy. Now, if you are an additional insured on the E&O or the professional liability policy, you may be taking away your ability to sue them simply because now you aren't insured, and a lot of the professional liability policies have insured versus insured exclusions. Okay, so being an additional insured on an E&O policy for a property manager really doesn't help you. It actually could hurt you more than it helps you. Now we have some policies, sometimes cyber policies. I mean, the same is true there. You want your own coverage, and to be an additional insured on the management firm policy really could restrict you from actually being able to go after the property manager if you need to. So realistically, when you're signing a contract with the property management firm, it is not uncommon for the property manager to be required to be named as additional insured on the association's policies. It is very difficult and may be harming the association by having them as additional insured on the property manager's policy. Most E&O policies automatically include the property manager. We talked about that. So if it's in the management contract, that's where it's picked up. And we've talked about the E&O insurance, and again, such things as the crime or the cyber. Better to have your own coverage and not relying on the property manager. That way, there's some recourse if you need to go after them. Point number 10: how to shop your insurance. I can't say that this is a slide that shouldn't change, but for the most part, every 3 to 4 years is a good rule of thumb, unless you're seeing two instances. One, you're seeing a 10% or more increase. The reason I said 10%, because by law, the insurance company has to issue notice that if they're raising the premium by 10% or more. And so anything under that, you won't get notice, and that may not be as important to, and I'll tell you why in a second. But so the first is where you're seeing a 10% or more increase. The second is you're being canceled by the insurance company. And we've talked about, Samantha and Vanessa have talked about how, whether it's the loss control recommendation. So if they're canceling it, then you really need to shop it immediately. But the reason I say you may not want to shop it every year is you burn out the insurance companies. And so eventually they will decline to quote. So if the insurance company sees the same risk coming every year and they don't write the insurance for it, eventually they're going to say, well, why are we going to do the work on this? We've quoted it 2 years in a row and we haven't gotten it. Now take that a step further. If they know this insurance is remarketed every year, they say, well, we're probably going to lose it next year, the year after. And realistically, an insurance company needs to maintain a policy for a couple of years in a row in order for it to be profitable. So if they write the insurance this year and they lose it the next year, it's actually they're losing money on it. So you want the insurance companies to be there to quote when you need them. So use them when you need them and don't get in the habit of shopping every single year, because the insurance companies know, and I can tell you as a broker, we walk away from quoting on accounts a lot of time because they're the same accounts that shop every single year. They bring in 4 different brokers and they think they're doing a good deed for the owners, but technically they're not. If you do need to shop the insurance every year, don't go to multiple brokers unless there's extenuating circumstances, as we mentioned above. We talked about earlier about brokers that specialize in habitational insurance. We can access most of the major insurance companies and programs. We can obtain indications without sending in full submissions, and we will know relatively quickly whether there is anything better out there. Now, we're in one of the worst markets in the history of insurance, as at least in real estate insurance, as I indicated earlier. So some of this may go out the window there, but if you are with some of the top insurance companies, the GMYs, the Berkeleys, et cetera, you're probably in a good spot. And yes, maybe you're taking a premium increase or maybe increasing coverage limit, but these are also carriers you want to be with. And sometimes once you leave them, it's very difficult to get back into it. Okay. So just keep that in mind. Never go to more than 3 brokers unless coverage is being canceled. Okay. Even in that case, you may want to limit it to 3 brokers simply because the way most insurance companies work is they work on a first come, first serve basis. So what they say is, okay, you send in a submission. If I send in a submission, I block the other broker. And so again, most of us have access to the same markets, and they don't want to see 7 different submissions coming in from 7 different brokers. Half the time they have all different information in it. They will end up declining it, or they'll put it on the bottom of the pile. So if you have 1 or 2 insurance brokers or 3 who specialize in co-op and condominium insurance, they're going to cover the market, and that's really all you need. Ask about raising deductibles. This can be a nice source of premium savings. If you wind 10 years ago, everybody had $1,000 deductible, and they started to raise to 2,500. Now 2,500 has become 5,000. 5,000 is kind of the norm. More and more associations looking at $10,000 for a couple of reasons. One, it's immediate savings. Okay, it's a lower premium. 2, it keeps them from submitting smaller claims, and claims are the single biggest reason why insurance policy premiums increase. So you don't want to be in the habit of submitting. If you have a $5,000 deductible and it's a $6,000 claim, well, you may want to think about taking a $10,000 deductible and not being able to put that $6,000 claim, because you may get paid out $1,000, but in the long run, the insurance company is going to recoup their money. And also, we've talked about more and more associations are starting to raise their deductibles and put the onus on the owners. And this is a way of doing so. They can raise it and they can reduce the premium, and the owners are picking up the deductible, which could be under their assessment. Anytime you're getting a proposal from a broker, please make sure you're getting a comparison of both the coverages and the premiums. I see brokers who send out an email saying same as last year. Though maybe they include a premium, they don't include coverage. Or you need to see what you're signing off on and what you're renewing, because I could tell you most policies change a little bit each year. Okay, and it may be just as simple as they're adding a new exclusion. So you want to be able to see a comparison. So make sure you're getting a comparison. Make sure they are including all the supplemental coverages such as water backup, earthquake, flood, and building ordinance. All 4 of those are technically exclusions from insurance policies. Now, the companies who specialize in insurance, as Vanessa mentioned earlier, they tailor their policies to be able to provide these coverages kind of on a all-in-one basis. So they have an endorsement that covers these. So you want to see that proposal, and you want to see whether there's water backup. I can't tell you how many times I see somebody come in with a proposal that's a little bit cheaper, but then they have no water backup coverage. They don't have ordinance coverage. And ordinance is very important, especially for old buildings. And most of the buildings in the city are getting older and older and need that coverage. Have your current agent provide a comparison of the options, not just a comparison of the premiums. We've talked about that as well. They should know what they're working with and what they're up against. And don't base your decision simply on price alone. There are important factors. We've already talked about the claim paying philosophy of the insurance company. Don't forget your relationship with the broker. Okay, it's very, very important. You know who you're dealing with. You know they're a specialist. Just because someone comes in a lower price, it doesn't necessarily mean it's better coverage. So base your decision on what is going to be the best for the association in the long run. And that could be price, but I can't tell you how many times I bring in a proposal to the board or a property manager. The first thing they do is turn to page 20 to look at the premium, and they skip the first 19 pages, which may or may not indicate, well, why there's a difference in the premium. So those are our 10 points primer. I'm going to go to some of the questions. I have a question about D&O lawsuits. Current board is being sued by a shareholder asking for monetary damages. They are suing board members individually as well, although individuals' decisions were made under their time on the board. Can you clarify if that is okay, or if courts allow this type of suit? Is it damaging to a co-op? Absolutely. People can sue board members individually, and a good D&O policy is going to pick up the individual as well as the association. You're also going to pick up prior board members and newly elected board members. So just because you're not a board member anymore doesn't mean you don't want to be defended. So a good D&O policy, yes, people can sue individually. And yes, a good D&O policy will pick this up. Damages from a roof leak causes damages inside the unit. Who is responsible for the interior repairs? Well, let's take who is responsible for what was damaged. That's the easiest way to answer it. They may not be insurance coverage for this situation, and I'll tell you why. A lot of the times, insurance policies have either of 2 exclusions which could apply. One would be they have exclusions for water that is been leaking for 14 days or more. So if you had a leak that's been ongoing for a month now, it's probably going to be, the damages are probably going to be excluded. There are also a lot of the policies have exclusions in them that say we don't cover interior damage unless there is damage to either the exterior or the roof first. So if you have a hurricane that rips a hole in the roof and then there's damage to the interior, well, they'll pick that up. If there is no damage, let's just say that wind-driven rain is getting in through holes in the parapet or in holes in the roof, they're probably not going to cover the resulting damage as well. So in this case, you have to refer to the governing documents and see who is responsible for what was damaged. And that could be both parties. We have in condos that have fuses, can the insurance company force the owners to change from fuse to circuit breaker? Force is I'm not sure is the right word. They can't force you to do so. What they can do is they can cancel your coverage or non-renew it. Okay. So an insurance company, and let's go with in New York. In New York, in the first 60 days, they can cancel coverage for any reason. And so if they do an inspection and say, wow, we have fuses, we want you to have circuit breakers, they can issue notice of cancellation right there in the first 60 days. After that, typically they can issue notice of non-renewal. So a typical insurance contract is 12 months. And after, let's say, 10 months, they say, well, you guys have not changed from fuses to circuit breakers, we're going to non-renew coverage. They can choose to do so. Oh, so they can't force you to change it, but you can't force them to continue to insure you. We noticed that a lot of carriers are starting to request fire alarm and sprinkler systems installed in the building as part of the annual inspection. Is this a new requirement? As many New York City buildings are pre-war buildings and grandfathered. At one point, we even had one carrier request the installation of fire escapes in a Chelsea pre-war building. How do boards ensure these things are done, as they are very time-consuming and costly to undertake? It is a good question, and I am seeing more and more of that as well. So you have insurance companies have requirements on the types of buildings and what buildings must have. But insurance companies also buy insurance from insurance companies. They're called reinsurance companies. And so sometimes these reinsurance companies have requirements. So if that insurance company wants to continue providing coverage, they got to meet those guidelines. But you do have more and more insurance companies who are changing their guidelines. And so it is difficult. There's still plenty of carriers out there who don't require fully sprinkled and alarm systems. The problem is we're seeing a lot of the umbrellas who require that now, so it is difficult. You're limiting your options. I have seen buildings that have one means of egress, and they have a very difficult time getting insurance. I mean, there's always someone who can provide insurance. The question is at what price? So the more issues you have or the more hair on it, the higher the premium is going to be, because it's kind of supply and demand. You're taking out you have less companies who are able to quote, so your premium is going to be higher. So it is a difficult situation. It's very difficult for a building that has one means of egress to all of a sudden put another means in, whether that be adding a staircase or fire escape or sprinkling the building. They're all very expensive and very costly. So it is tough. Again, we are in a hard market. Insurance is cyclical, so hopefully at some point the market will change and the carriers will hopefully start loosening their guidelines. But some of these are tough you may not be able to comply with it. And that may just limit the amount of insurance companies that you are going to be able to get a quote from, which means you may be paying more in insurance costs than the building next door, which is identical to you, other than the fact that maybe they have that sprinkler system or that means of egress. What have you seen as best practice to confirm yearly that shareholders are properly insured? We send notices and only 50% of the shareholders comply. Good question. I can answer from experience. We actually recently formed a department that monitors homeowners insurance in buildings. So first, let's take a step back. Is it required that they maintain insurance? If it is, then we would go to step 2 here. If it's not required, then they are not going to reply or comply in most cases, because they don't have to. There's got to be something saying you have to. So let's go back to if it's required. If it's required and it's in the bylaws, typically there should be something in there saying, hey, if you don't respond, this is what's going to happen. There are services out there like our agency. Again, we formed a department that for a fee, you send us the list of the owners, the list of the insurance requirements that you have, and email addresses, and we upload it into a platform that follows up with everyone. And there's certain deadlines that they got to respond to. And it's very easy for the owners, because what they can do is they can register their insurance broker. And that's the easiest way, and where we see the most of the shareholders complying is they register their insurance broker. We reach out to the insurance broker, they supply the information, and we supply the board with reports. So that question, I'm going to say, I would probably shoot me an email. We could discuss a little further, but it's very difficult for a board to manage the process. And it's very, very difficult and should not be put on the property manager either, simply because it is a time-consuming process and you have to do it right. And when I say right, you have, let's say there's 60 owners in the building. Well, even if you get everyone to show you proof of insurance, they all have 60 different expiration dates. So you may have everyone supply proof of coverage on February 1st, but if someone's policy expires on February 15th, they may have complied on February 1st, but they let the policy lapse on February 15th. So you need basically outside help on this. How does waiver of subrogation work with liability, umbrella, and workers' comp? Waiver of subrogation basically says that if you can't subrogate, okay, and so if a party's insurer is paying for the claim, you can't go back and subrogate against them, okay? And in workers' compensation, it gets a little bit more entailed, because what you have is sometimes you have parties who are injured. They are collecting workers' comp and they're subrogating against the liability of let's say the building in this case. So that's a question that probably is going to take a little bit to answer. So I would suggest emailing me offline. What do you have with someone like an entertainer who does not have any insurance, who will be singing at an association event? They can take out special events insurance to cover them for that event. And that's probably the simplest answer to that question. Okay, if they don't have insurance, they can take out a one-day policy or forever, how long the event is going to be. And to Marianne, thank you. You're welcome. Thank you for the kind words. Will the D&O cover a managing agent that is no longer managing a property, but the claim was during their tenure with the building? So the D&O claims are claims made. So the carrier who's on the time of the claim is responsible for responding. The answer is yes. So if they were in effect as the management firm, there was a contract, and the D&O carrier should pick up the coverage. Does co-op governing documents, i.e. the proprietary lease language regarding insurance coverage and liability, supersede co-op master policy language, particularly subrogation clause? Excuse me. I just got to reread that one again. Does co-op governing documents, for example, the proprietary lease language regarding insurance coverage and liability, supersede co-op master policy language, particularly subrogation clause? Well, the subrogation clause, if you're talking about the insurance policy, typically the insurance policy abides by the association documents. So if there's waiver of subrogation inside the governing documents, the insurance company can't subrogate. Could also be endorsements to the policy waiver and waiving subrogation, but that doesn't happen too often. That also may be some law aspects, so you may want to ask an attorney on that one. If the property manager is negligent in supervising vendors by submitting change orders 2 months after work completed without written authorization from owner or owner's signatures on a change order, which require all parties, contractors, engineers, and owners sign prior to work, AA agreement stated owners should not be paying for work without written authorization. I don't really see the question there, but I do think I know where you're going with that. If you have an issue with a property manager and they have failed to meet the terms of the contract, you certainly can choose to sue them, and that's where they have E&O coverage. If a claim was brought against the board for ADA handicap accessibility, could the board be potentially denied coverage if they knowingly discriminate against an individual? The answer is absolutely. Absolutely. You cannot knowingly, you can't discriminate, period. Intent is another exclusion. So the answer is yes. If they are knowingly discriminating against an individual, then the answer is yes, they can be sued. How much can the board rely on the broker to give a comprehensive comparison of coverages from year over year, or if marketed? A good broker will always provide that, and I know we do. I know several other brokers who do as well. They typically will compare coverage to last year to this year. If they've gotten alternate quotes, I know we do. We will put that in there. We have a marketing results page, as does all the other brokers. And again, as Samantha or Vanessa had said earlier, you don't go to a podiatrist for brain surgery. Well, if you're going to brokers who specialize in co-op and condo insurance, they know what they're doing, and they will give you a comparison from year over year. And last but not least, could board members submit complaint or claims to property managers who committed negligence of supervising contract and engineering repairs project cost over 3 times original budget? Probably a law question, but could they submit a claim? I mean, the answer is absolutely. Anyone could submit a claim for pretty much anything, and that's the reason why comprehensive insurance is needed. So they certainly could. Property managers typically have what's called E&O insurance. Excuse me. And again, if they're not meeting the terms of their contract, if they fail to meet it, that is where your recourse is. So, and another question just popped up: should a co-op add management company as additional insured, or should they maintain their own coverage, E&O, D&O? Both. Management company should have their own E&O coverage, because the E&O covers really them for what they're supposed to be doing in terms of what the contract is. But the co-op should add the management company as additional insured on the liability and D&O coverage, because the management firm, again, is going to get named in every single lawsuit along with the association. And their management contracts basically say that the association needs to indemnify them and pay their legal costs. So yes, you want to list them on the liability and the D&O, but yes, you also want them to have their own E&O coverage. All right, I think that is it. I thank everyone. We will be sending out a copy of the recording afterwards. Our information is on the screen now. Please feel free to reach out with any questions. There were several questions here that probably take a little longer than we have to answer them. So by all means, please reach out. Thank you, everybody.